Welcome to the Bulletproof Cash Flow Podcast, the go-to place to gain financial freedom through real estate investing. Here we interview investors, mentors, and entrepreneurs who share their secrets and advice to help you build passive income. Let's get into the show.
Hey everyone, it's Augustino. Our next guest has been a real estate entrepreneur for nearly 20 years. After graduating with an engineering degree and then an MBA from Ohio State, he entered the management development track at Ford Motor Company in Detroit, where he stayed for 5 years. He then left Ford to start a staffing company with a partner and ended up selling it for nearly $3 million 5 years after that. So it was really the early 2000s where he entered the real estate sector. He started doing fix and flips of homes and created 2 successful online real estate marketing firms. And he actually appeared on House Hunters on HGTV as well. But what is most revealing is that he is the author of a book, The Perfect Investment, Creating Enduring Wealth from the Historic Shift in Multifamily Housing, where he discusses multifamily. And he also co-hosts a podcast, How to Lose Money, where he interviews experts in the real estate game. So with all that, I'd like to welcome Paul Moore to the show. Hey, Paul, thanks for coming on. I appreciate it.
Hey, it's great to be here, but why in the world would you have somebody on your show who teaches people how to lose money?
We're going to get into that, aren't we?
Yeah, I guess we will. All right. It's great to be here. Thanks, Augustino.
Thank you. So before we go on, if you like what Paul has to say, you can find him on Bigger Pockets. You can also check out his podcast at howtolosemoney.com, or also you can see him on his website too at wellingscapital.com. So tell us, Paul, how did you get into the business?
So, I didn't know anything about real estate as a kid or, when I was growing up, and I got an engineering degree, which was my first mistake. And then I got an MBA and I did the business that you mentioned. We sold it to a publicly traded company. I was finalist for Entrepreneur of the Year a couple times through there, and that was amazing. But, people think that it's so notable and so exciting to retire like in your mid 30s or 40s. I semi-retired at like 35, 36 years old. And I can tell you it was completely boring. And it was actually a miserable time for me. I was probably the worst version of myself as a husband, as a father, as a friend. I was bored. I was a high energy entrepreneur. We'd never heard of home flipping, the term, for years, but we started buying houses on the courthouse steps. My friend and I, we started flipping them and made a good deal of money at that. And I thought, well, if we can make money at this, we should be able to make even more money by building a house. Now, Augustino, if you don't know how to tighten or if you don't know how to install a doorknob on your house door, you probably shouldn't be a builder. But hey, that didn't stop me. And so a lot of stories from How to Lose Money came out of that era when I tried to be a builder. And then I flipped waterfront lots, started a website that still generates leads for residential realtors today. And then I eventually got into multifamily by doing all kinds of things in that arena as well. So that kind of takes us up to the last 7 years or so now.
Yes. So, but that's often a big shift, though. I find that many people that come to my live events are talking about single family as the be all to end all. In some cases, they haven't even considered doing multifamily as a business. So how did that switch flip for you? Like, how did you realize that multifamily was the answer?
So I kind of backdoor stumbled into it. We were actually doing multi or single family still, and then the recession hit. That all ground to a halt. Waterfront lots, ground to a halt. I went from $1.5 million in the bank to $2.5 million in debt by 2007. So in about a 10-year span, I had a lot of assets, but trying to figure out a different path. And so I had this petroleum engineering background and decided to look into the Bakken oil rush in North Dakota. And so my friend and I went up there, and every time we went up there, he had a small jet. We would have to fly back, or he would usually have to fly out to somewhere else, like to Bismarck or to South Dakota or back to Colorado where he's from, because there was no place to stay. And this was around 2010. And so he said, hey, we're both in real estate. Why don't we build a hotel? And then we researched more. Well, why don't we build apartments? Researched a little more. Why don't we build man camps? Yeah. So we man camps were these metal boxes that they put guys in. They stuffed them in like sardines to work in the oil fields there. And these guys are making like 90 to 120,000 a year, sometimes out of high school. There were 18,000 job openings. There were trucks parked all along the roads and then, in fields and at rest stops because they couldn't find a place to stay. So we ended up building a really high-end man camp. And we said, look, if oil prices really drop, we're going to be the last one standing. We'll be the one that, where people want to live or want to stay after the oil boom is over, when it becomes like a production cycle situation instead of a drilling time. So we built these beautiful 300 square foot cabins. Each unit was 300 square feet. It had a big screen TV, and some of them had granite countertops and high-end custom cabinets. And we rented these out. Augustino, in the heartland of America, apartments rent for, let's say, $1 a square foot a month. So an 800 square foot apartment might rent for $800 a month, for example. We were actually renting these at $13 a square foot and staying full. So we were renting these for about $3,900 a month. And that included utilities and internet and all that, but we were making a lot of money. And so it was like a quasi-multifamily, quasi-hotel. And so that's how I ended up in the business. When we went to sell the company at the height of the oil boom, I didn't even know anything about real multifamily. One of the potential buyers said, "Show me your rent roll." And I said, "Show me what?" So I didn't really know the specifics of multifamily. But as soon as we did that and sold it, we ended up building a very nice hotel that did not go well. And then I decided I really want to learn multifamily the right way. So I went into a mentoring program. Long story, even longer at this point. I mentored under a company for a year, and that's how I got into multifamily about 2014.
Yes. And now, of course, you're with Wellings Capital now. It's your company. Tell us a bit about the company. So how's it structured? How many units are you guys up to?
So Wellings Capital, all of the owners decided, first of all, we had other businesses, other sources of income. I mentioned a couple real estate websites that I have that generate business. We came together, we were in our mid to late 50s, and we decided, I know I don't look a day over 40, but you can't see me out in audio land, but you can see me, Augustino. I'm kidding. But seriously, we didn't want to lose any more money. We all decided, man, we've lost money. We've made money. We are going to be super, super conservative. And we're going to learn this business. We're going to structure it, set up the website, set up the systems, get investors. And we're going to wait for this apartment market that's so heated up to slow down. And so we waited. And we waited and we waited. Then we started, we bought some assets last year. But honestly, we have been more in the investor gathering, waiting mode. And we've come to the conclusion, Augustine, I'm going to ask you, what do you think? Are we in a bubble, or is this just the new normal? I don't know, but I'm kind of wondering if it's the new normal in the apartment world.
I think that there's definitely a lot of heat going on in the markets. I think it's not sustainable, though. With rates going up, it's going to cause a bit of a slowdown. But certain markets are overheating, such as let's say Orlando, Tampa. Those markets are on fire right now. Here in the Cleveland area, yeah, it's still fairly hot. I mean, there's still deals out there. It just requires a great deal more work. But there's still deals to be had here. That's the thing. I guess it varies from market to market. Now, is it the new normal? I don't think so. I think right now it's just in vogue. It's eventually I think it'll eventually cool off a little bit. It has to, because the rates they can't stay as low as they are.
What would you say to somebody else? I don't mean to put you on the spot, but what would you say to some of our international investors from places like Australia or China or Europe who would say, you guys, your 5.5% cap rates are no problem. We are at 3% cap in our country, or people from LA or New York who say that they're at 3% cap rate, or even Denver in some cases. What would you say to them? What would you say to somebody who says that, our 5.5 is no problem?
Well, see, that's where it gets a little bit different. We actually have investors from California, for instance, in Seattle, that invest in our deals here in Ohio, where it's still possible to find 10 caps out here. It is. For good properties. It is possible. Out in California, for instance, you're going to find garbage for 3% at a 3% rate. But there are different markets, like Ohio being one of them. I'm really bullish on Ohio. Some people don't like Cleveland. I think it's because they don't understand the market. But I understand that I've been here for a little bit now. So I love this market. Columbus, for instance, is a very large MSA, and they're experiencing a bit of an overheated market, in my opinion. Very difficult to find deals out there. But here in Cleveland, yeah. So basically, when it comes to talking to some of those foreign investors, I basically say if you do want some rich returns, pick the syndicator and pick the market properly. That's ultimately what it is. Yeah, absolutely.
I mean, if you don't mind me asking, how do you find a decent deal that's actually a 10 cap, where the rate of return to the investor might be, in the 10% range with no leverage?
What comes into play there is really understanding the local market down to almost the street level. Like there's deals that I'm actually working on and deals that I've done that, for instance, there is an Amazon distribution center that's moving into a city. I just happened to get wind of it. And that isn't like I'm privy to any non-public information, but I also understood that a very large deal just went for sale right down the street from that DC distribution center. So I went ahead and pulled that deal down, got some partners together and pulled it down, right? So that's not going to be on the market. That's just going to be us staying active in the market. That's what it is. I mean, there's another deal where there's a really nice rebuilt spot in the city. It's like a square, right? Shaker Square. And I just happen to know that a block over from Shaker Square, where it's not so nice, a building goes up for sale. And the city plans to revitalize that whole street. I just happen to be privy to that information because I stay connected with the local community, right? So that deal had been on the market for a long time. Everyone stayed away from it because they didn't understand that if the city plans on rebuilding that whole strip and you can get it for a decent price, you can go in there, fix it up, turn over the tenants, and you have a winner, right? So that's better than a 10% cap. It is possible, but it comes down to understanding your market. That's really what it is.
And I think what you just pointed out is something that you have probably done better that we, Wellings Capital, where we have failed. And I'll tell you that we went through a lot of gyrations on this decision, but we decided, okay, we want to really focus on Atlanta, and Charlotte and Raleigh and Greenville and Knoxville, Nashville, Lexington, Louisville. And, and that doesn't even include 3 cities in Texas. And so we have not really, really deeply gotten to know like every block, every neighborhood, every area of one single MSA. And I think that sounds like that's something that you've done very well at. Am I right?
Yeah. But you know what, though? I think that's the market today. You have to be that detailed. I think that strategy you just pointed out, that would have worked like, say, 8 years ago. Target a market and, okay, we're just going to go do Nashville. Here's 5 buildings. I'll buy them all. You could have done that back then. Today, not so much. You really have to know the market. That's why it's like I have friends and family that ask me, hey, you're going to start investing in PA, or you're going to start investing in Florida? At some point, yeah, but right now I got to stay in my backyard. I have the processes, procedures, the management in place here. So for me to purchase a building, bring in my team to renovate, for instance, and implement property management, it's very easy for me because I have the same people. It's all the same guys that do all this, right? So it's the process already in place. It makes it very easy to scale, right? As opposed to jumping around to different places, it's very, very tough to do.
Makes sense.
Yeah, absolutely. So as it is right now, then you guys are basically raising capital, and you're still taking down deals, though, right? In some of those places that you mentioned.
Well, we're looking at deals all the time. And I mean, we just looked at one in Kansas City as well. So add that to the mix. But we actually, for a lot of reasons that I could describe if you'd like, have decided that we're a lot better at raising money than we are at acquisitions and at asset management, perhaps. And so we actually are kind of trending more toward raising money for great deals for other great operators. So that's what we're doing right now. We're about to raise for our 3rd deal for another operator in the area of self-storage.
Okay. So before we go into the self-storage realm, a question about the fundraising side. So are you raising capital on a deal by deal basis? Are you setting up like an investment fund, or how are you situating that right now?
Yeah, we're thinking about doing a fund, and we've been talking about it for some time, but right now we're doing it on a deal by deal basis. So we, if you set up a fund and say, okay, my goal is to raise $40 million, and you get into it a little bit, you just want to be really sure, man, this is like a big commitment that might take, like 6 months or a year to raise that or more. And we thought it'd be better just to go a deal by deal basis. It's part of that same philosophy I mentioned a few minutes ago. I hope it comes with age and wisdom of just moving slowly and not rushing into things. I remember when I was in my 30s, if I would have heard something I wanted to do, like starting a bigger fund, I would have had it set up, if possible, within days and up and running, and I'm just not that way anymore, because I've seen the wisdom in really, really getting a multitude of counselors, getting advice, looking at the pros and cons, and that's what we're doing.
Yes. All right, excellent. Well, I know you wrote this book, and I always love speaking with authors because they have a deep knowledge, a perfect investment. I know it's all around multifamily, but when is the perfect investment no longer a perfect investment?
Well, let me take a minute to tell you why I called it that. The original name for the book was The Definitive Guide to Multifamily Investing. And a friend of mine said, man, it's a great book, but it's kind of a boring title. He's like, you're going to be basically marketing to people who are already sold on multifamily, which is, that's great. But he said, why don't you get a title like Rich Dad, Poor Dad, or something that's kind of epic? He said, in the book, you make the case in chapter 4 and 8 that multifamily has incredible demographics. You can look out for years to come and see that multifamily is going to be strong. It's bolstered by the fastest growing segment of renters, which is actually baby boomers. It's bolstered by the largest demographic sector, which is actually millennials, and they tend to rent at a 65 to 35 ratio, as opposed to their predecessors who rented almost the opposite to home ownership. And it's bolstered by immigrants who tend to rent for longer and more often than people who were born in the US. And so these trends are amazing. The risk return ratio is amazing. The Sharpe ratio is as high as anything else out there. It's like 4 times better than the S&P 500 and the Dow Jones. And by the way, the Sharpe ratio is a measurement of return divided by risk, meaning the variation in the return. So it's the return divided by the standard deviation of the return. And so the Sharpe ratio is really the greatest measurement that I know of what somebody would want to invest in. It measures stability, predictability, the percentage return itself. And apartments and self-storage are at the very top of the heap of all the asset classes, including retail, office, industrial, but like I also said, private equity. The S&P 500 and Dow Jones are way, way lower because they go up and down so much. As we've seen, as we're recording this podcast, we're watching the stock market in a semi-free fall this week. That just doesn't happen with apartments. It doesn't happen with self-storage. In fact, in the recession, they actually fared very well. You know that where single-family homes had as high as a 9 or 10% foreclosure rate with private banks and a 4.8% foreclosure rate with Freddie and Fannie, multifamily was like 0.4. And now, so it was like 90% lower than single family. But get this, now that things have stabilized, multifamily is 98% lower foreclosure rate and default rate, for Freddie Mac at least, than single family. In fact, I heard a statistic from the Mortgage Bankers Association that there's virtually zero foreclosures in multifamily in the US in the last 4 years. And so check it out. It is the perfect investment. The problem is a lot of people believe that. You and I believe it, Agostino, and a lot of investors believe it. And the problem with that is when a lot of people believe something, there's a bull market. And so the perfect investment becomes an imperfect investment if you can't find a deal that makes sense. And you've made the case that you can. And that's great. You're doing a better job than us in finding deals, but we're not finding deals that make sense typically. They're not penciling out. So that's why we've decided to expand our focus to invest in self-storage, and we might even expand into mobile home parks as well.
Yes, I actually like self-storage as well. It's one of those things that always trails right behind the multifamily roller coaster, if you will. I was going to say trend, but it's more like a roller coaster these days, right? So now I know that you're investing in those. Are you building them out? Are you acquiring existing deals? Like, how does that work?
As far as self-storage goes, we are evaluating the possibility that we will acquire our own and will asset manage them. We've been to a combined total of 3, about to go to a 4th conference on self-storage. We're learning all we can. We're evaluating deals on our own. But right now, we're investing with people who've already been doing it for decades, and we're really enjoying that.
Yes, good. What sort of markets are you going to be attacking then when it comes to self-storage? Are you looking at the same sort of thing when it comes to multifamily, primary, secondary type markets?
Yeah, in multifamily, the markets, we're very, very stringent with about 22 criteria we want to apply to see if we want to purchase in a specific market. Self-storage is very different. There are 53,000 self-storage facilities in the U.S. About 40,000 are owned by mom and pop operators. Some of those are in the path of growth. It's actually pretty easy to build and manage a mediocre and even a decent self-storage facility. It's actually very hard and complex to do a great one. And so we are partnering with operators who are able to acquire these mom and pop facilities in the path of growth and then take them up to being a great operation and then packaging together a bunch of them together and selling them to a REIT. Just selling to a REIT can drop the cap rate, which means increasing the price, of course, from about a 7.0 cap to about a 5.2 cap. That is enormous in and of itself, and here's why. That's a 26% appreciation just from moving that lever from everything else, all things being equal, moving the lever from a 7 to a 5.2 cap. That's a 26% increase. That sounds pretty good, but when you take into account the beauty of leverage that we all know about in commercial real estate, that 26% appreciation to the investor might be more like a 78% appreciation because, you might have a 75% leverage. And so that's huge in and of itself. You add to that you're adding point of sale items. I'm going back to the income side now. You're adding, things like boxes, scissors, tape, locks, U-Haul rental, which can be thousands a month, selling insurance, raising the price on a certain schedule, better marketing, all kinds of things you can do to drive more income. Well, you can see why it's feasible in about a 3-year period to take an asset and double or triple the investor's money, especially when you include leverage on it. And this is happening a lot with great operators. And by the way, I forgot to say the greatest value add with self-storage is if you have empty space, like empty parking that you're using for, RVs or just empty area that you can put another building in. Putting a state-of-the-art, climate-controlled facility in with, a current self-storage facility is one of the greatest ways. You already have the land, you already have the management team, you already have everything. Now you put on, a 2 or 3 story building and it just jacks the returns incredibly. So you can see why I'm excited.
Yes, absolutely. Now, how does leverage work on a deal like that? Well, I believe it's different than just doing a regular multifamily because they typically secure it by the asset itself and by the leases and all that. So when it comes to self-storage, is it the same sort of deal? Like, how does that part work?
Yeah, it's about the same. So, you might have a 65, 75% leverage, and you might even have up to 85% leverage on a construction loan, a bridge loan, just like multifamily. We would tend to go with operators who have a lower LTV and are a little more conservative.
Interesting. So I know you've done a lot of mistakes in the past, especially when it comes to multifamily, right? And you alluded to that. What would you say is probably one of the biggest mistakes you've made, and what did you learn from it?
I don't think we've made any significant mistakes in the area of multifamily specifically. I mean, the Hyatt Hotel we did we learned a lot about the importance of not jumping ahead of zoning. So we were in an area that was zoned where we could put the hotel, but we believed that there was going to be a medical center and or a Walmart coming in across the street. And so we jumped on it. We got the land for cheap, and we thought we were, celebrating the great deal we got on the land. And we were actually able to sell off, I think it was 27 of our 29 acres to a subdivision that we platted out and made a couple million on. The other facilities in town did not materialize. The Super Walmart and the medical facility did not materialize. And the other hotels were in another part of town. It was 15 minutes away, but they were not in that area. So it was kind of standing alone in an area of super future growth. And that future growth was dependent on oil prices because we were in a boom town. Well, guess what? When oil went from $110 a barrel down to about $33 a barrel in a very short time, so did our business. And so that is, so many lessons learned there. But I think the biggest lesson that I've learned in all of my investing has been about the law of risk and return. Now, we think that low risk is going to equate to low return, and that's true. The problem is our brain therefore says what? High risk therefore equals high return, but that's not true. High risk projects a possibility of high return and also an equal or greater possibility of high loss. And so I think the problem for me is over the years that I confused investing and speculating. Investing is when your principal is safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. And so I think I sometimes confuse the two. And that's what got me into a lot of trouble over the years. And a lot of my trouble was in the area of development, believing, ground up development or a new entrepreneurial startup or a new shiny object was something I wanted to chase. And so I considered myself, I didn't tell you about all the other, I think 11 companies I started over the years and, including a wireless internet company, things I had no business doing. So I think that those speculative ventures that had this massive potential return were the biggest mistakes I made. One of the biggest was investing in oil and gas. And it wasn't good enough for me to go into the Bakken, North Dakota oil play and, hopefully get a 15 or 20% return on my money. I wanted to do a wildcat well in the North Dakota Bakken. So we invested with a company that was using this brand new technology to do this massive, incredible 5 million barrel oil wells up in the middle of North Dakota. And they had hit, using this technology, people had stumbled into 5 wells that had 4 or 5, 6 million barrels each. And so this company had systematized that technology. And literally the 2 owners of this company were poised using this technology to be the wealthiest guys in the world because of just the land holdings that they had secured to drill on. Well, it didn't work. It came up with zero. I mean, just the picture of dropping money down a hole in the ground and hoping a lot more money comes out is a perfect picture of speculation. It didn't work.
Yeah, I think that's what happened in the last economic cycle too. It's there's a lot of speculation. We think that our single family homes are going to quadruple in value in the next 3 months.
Right.
So we're just going to go ahead and buy all these, right? Are you seeing the similar sort of thing happening right now when it comes to single family? Not so much in the multifamily. I know we talked a little bit about that, which is also probably why you want to get into the self-storage space. It's also sounds like a really perfect investment there. But are you seeing the same thing happen as far as the economic cycle is concerned when it comes to single family?
Yeah, so anybody who is buying a safe, secure, cash flowing investment is usually safe. They used to say cash is king. Well, I'll say cash flow is king. Betting on appreciation is where you get into speculation because it's uncertain. And, honestly, not to offend you or your audience, but that's where I had a problem. Not a problem. That's where I was trying to tell people to watch out for Bitcoin because there was no certain income stream, and therefore a value investor like Warren Buffett or Howard Marks would say there's not an intrinsic value that can be attached to Bitcoin. And of course, when it went from $1,000 to $19,000 and then back to $6,500 about a year ago, we realized things that have intrinsic value don't act like that. Okay. And so my advice to investors is focus on cash flow, don't over leverage, and get into assets that if things go down and appreciation goes to zero, you're still okay because you've got a cash flowing asset. Rod Cleef, who you've heard of, in Florida, he had a lot of single family homes that he was betting on the appreciation. He also had a lot of multifamily in Florida. And when everything went south about 10 years ago, the single families dragged his whole portfolio to, I believe it was bankruptcy for him. And he said if he only would have had the multifamilies, he would have been fine.
That's right. I think many people make that mistake, that they think that doing single family is a business in itself, and it really isn't. It's difficult to scale, difficult to build, difficult to manage. I don't understand why people would even do that to the scale that Rod Cleef did. Although he did learn a lesson. He's not doing that now.
Right. Yeah. Hopefully he learned a lesson. I think he did.
Yeah, I think he did too. Now, what's been your most satisfying moment in the business world?
Yeah, so I could tell the detailed story, but the summary of it is, which I alluded to earlier, is where I went from $1.5 million in the bank to $2.5 million in debt, late 2007, and through a lot of prayer. And we made some decisions as a family to begin to give very generously to causes we were really passionate about. And when we made that decision 4 weeks later, which was the end of January 2008, we didn't know how bad the recession we were going into was, of course. But 4 weeks into that, I came up with an idea that resulted in us being completely debt-free in 13 months. And so that was my worst investment that actually became my best investment in the year 2008. That's my happiest memory. And it kind of spurred me into this real passion that I have to tell people, look, the person you are now is who you're going to be if and when you become very, very successful. So if you want to be generous someday, start being generous now. Start giving now. Start giving back your time, your talent, your treasures to things you care about. And what I'm passionate about is fighting human trafficking and rescuing its victims. Agostino, I don't know if you've heard this, but if you took the record profits for Apple, General Motors, Nike, and Starbucks, record profits, added those together, doubled that number, that's the approximate total revenue generated by human trafficking every year. It's a crime. And I want to believe that if I was alive in the mid-1800s, I would have been an abolitionist fighting against slavery in the U.S. And if I would have been an adult in the 1960s, I would have been fighting for civil rights. Well, this is slavery. It is a civil right. It's been ripped away from between 21 and 40 million people worldwide. And so I want to fight it. So I'm passionate about raising awareness, raising and donating $1 billion in the rest of my life to fighting trafficking and rescuing its victims. One way I'm doing that is I'm actually part of an organization called Freedom Place, freedomplaceproject.com. We're not soliciting any donations. We're not looking for any donors or anything like that. We are going to build a $1 billion office complex in Dallas, and we're going to give 100% of our developer profits to fighting trafficking and rescuing its victims. And we're hoping to use that as a model to do in many other cities across the U.S.
Nice. Yeah, I have heard of the serious problem, and I'm glad you're attacking it because it breaks up so many families. It hurts so many people. It really does. It's terrible.
Yeah, it really is.
Yeah. So now let's go into the mogul round. Are you ready?
I'm ready.
All right. So if you can give your 20-year-old self a word of advice, what would it be?
If I could give my 20-year-old self a word of advice, I'd hope I would be willing to listen. But I would advise myself not to chase shiny objects. The people most successful in this world, Agostino, people like Bill Gates, He decided what he wanted to do when he was, pre-20. And he has stayed hyper focused on that one thing his whole life. Warren Buffett, same thing. After one failed gas station investment in 1953, I think, he has stayed absolutely focused on one thing his whole career.
Yeah.
Serial entrepreneurs, man, if I was going to put that on my business card, I wouldn't, because I used to think that was a cool title, but really it can be a title for somebody who's chased too many different things. And the problem is, if you learn one thing really, really deeply, like you have learned the Cleveland markets really, really deeply, and stay focused on that and be an expert on that, you're going to be way ahead. And my hat's off to you for doing that, my friend. But I would tell my 20-year-old self, stay focused on one thing and see it through the ups, through the downs, through the up markets, the down markets, the recessions. Howard Marks talked about on a podcast I heard the other day on Tim Ferriss's show. He talked about how as everything hurtled downward in late 2008, Lehman Brothers had gone bankrupt. All kinds of other firms were rumored to go bankrupt. He was buying a $500 million a week in non-performing debt. And a reporter said, "What? You're buying?" And Mark said, "If not now, when would I?" And, he rode that. He's ridden that train from the 60s right through now, and he's very successful. And so that's my advice. Stay focused on one thing. I would trade my house, my net worth, not my family, anything else I have for being able to go back to my 20s and do that well. And I would have absolutely done commercial real estate if I was going to do anything.
Yeah, I totally agree. 100%. Now, what are your 3 most influential books and why?
Yeah. So one is called Shattered Dreams by Dr. Larry Crabb. I won't say it was the impetus for my podcast, but it showed me that, the pain and the difficulties of life are part of a beautiful tapestry that's being woven in our lives and throughout history. That, there's a dark side on the bottom. If you look at the bottom of any tapestry, it looks like a big tangled mess. But if you look at the top, it's beautiful. And so Shattered Dreams taught me that lesson by Dr. Larry Crabb. A second one is The One Thing. It's probably been on your podcast before. Gary Keller of Keller Williams, of course, and Jay Papasan. It teaches you to focus on, again, one thing in your life as a whole, but one thing every hour as well. What's the one thing I can do this hour that by doing this, everything else becomes easier or unnecessary? So I'm trying to live by that book. And then a third one would be by Oren Klaff. Oren was on my podcast recently. It's called Pitch Anything. And I love that book. I listened to it over and over. I've read it, and I'm looking forward to his next book, which is called something like Persuade Anyone.
No, that's a great book. I've read that one. Amazing book. I've already listened to it twice myself. Yeah. So now, what do the next 5 years look like for your business?
We're having a little debate internally. We're trying to decide, do we want to continue to acquire assets like multifamily and self-storage and manage those ourselves? Or would we rather take a smaller cut of a much bigger pie by just focusing on raising money for other great operators? So we're kind of up in the air on that. And ask me again in a year. We'll let you know where we are. But I think, it's likely that at least me personally, I'll continue to raise more and more money for more and more deals.
Well, you know what then? Maybe next year I'll have you back on the show and we'll see where you're at.
All right. Fantastic.
Awesome. All right, guys. Well, if you want to follow up with Paul, you can reach him via his contact page at willingscapital.com. Don't forget to check out his website, How to Lose Money. There's so much value in this discussion. Thank you so much for your time, Paul. I really appreciate it.
Yeah, it was great to be here, and I really, really appreciate what you're doing, and I love your focus, my friend. Thanks.
Thank you for listening. We hope you enjoyed the Bulletproof Cash Flow podcast. For more free podcasts, articles, videos, and resources, go to www.bulletproofcashflow.com.